Whether you are a beginner investor or simply interested in investing, you might be wondering how to invest $100 right now, what is the intrinsic value, what are earnings per shares, or simply why to invest today? Great questions, and here are the answers. Hi, Jared here, and today let's answer some investing questions. And first, we'll go over the most basic ones all the way through the most difficult questions to answer. So, to start with, what is investing and what is my own approach to investing? Really straightforward. I want to have more in the long term, so let's say 5 to 10 years at least. To make things simple, let's take the stock market, which is a place where we buy and sell shares of a company with the help of money, like the euro or the dollar. The more people invest in that company, so the more they put their money in, the higher the price will be, and the higher the market capitalization, so the total value of all shares. Then stocks represent an ownership of a company, so when you buy stocks in a company, it means you own a part of that company. Stocks are issued by companies to raise money to grow their business. Usually, owning at least one share gives you the right to vote and participate in the growing earnings of the company. Then, why invest in the stock market? Well, the most obvious reason to consider investing in the stock market is to help you grow your own money over time. You are also supporting other companies to grow and supporting the economy as a whole. I love Apple and I own some of their products and services. Alright, then how to even start investing? I would say that we should simply learn first and then practice. You should start by reading books. They are packed with hundreds of interesting topics and fundamentals. They tell you what to look for and what to avoid also. I personally read different investing books from different authors too, from Benjamin Graham to Peter Thiel. I know some people don't like to read, they find it boring, sometimes a loss of time, but I found that the vast majority of what you find on the internet already comes from books. They've just been written again by someone else, but the main idea always comes from books. I would recommend reading in order Rich Dad Poor Dad from Robert Kiyosaki. This book helps me understand what really is money, how to invest in assets as opposed to liabilities, and what we are learning at school, and so on. The little book that still beats the market by Joel Greenblatt. This book is highly simple to understand and anyone can read it easily. Then, One Up on Wall Street by Peter Lynch. This book covers everything we need to know with a great analysis of businesses. The Psychology of Money by Morgan Housel is a classic we all need to read to broadly understand everything about money and how it shapes our world. And The Intelligent Investor by Benjamin Graham. I put it at the end, right? But this one is by far the most important and complete book to read. Benjamin Graham is the founder of value investing, so investing in great companies at a bargain price, while being Warren Buffett's mentor. So basically, this book will teach you everything you need to know. Then, when should we start to invest? Some people started very early, like Warren Buffett when he was only 11, while others started at 50. Is there a real difference? Well, there is more than one. The earlier we start, the better, no matter how skilled we are or how experienced we are. Because the earlier we start, the more we will have at the end of our journey, thanks to something called the compound effect. You know, this is like a penny doubled every day for 40 days. It doesn't seem like that much, right? But in the end, you won't have $1,000 or even $5,000. No, you will have $5 million. Warren Buffett already had $100,000 when he was 20, and he made 99% of his current wealth after he was 50. And this works because he reinvested his dividends and gains, so each time he invested more and more. So keep in mind that the earlier we start, the more we will have in 20 to 30 years. And this brings us to how much we should invest. Well, the best answer I ever received was what we are willing to lose. There is no complicated math, ratios or equations to do. You can save half of your income and invest the other half, or 20% into savings, the other into investing, or maybe 5% into investing and 95% into savings. Always keep in mind that the money you invest can be lost forever. And personally, I keep investing a third of my income into the stock market, I invest a third into Tesla, real estate and cryptocurrencies, and I keep a third of my income each month. Alright. What are ETFs? Well, ETF stands for Exchange Traded Funds. You can basically picture it as a basket of stocks or commodities such as gold and silver, for example, and also currencies and so on. And it replicates its performance. So if gold goes up by 1%, the ETF will go up by 1%. And this is useful because we can buy an ETF that tracks the S&P 500, for example, which is the basket that tracks the 500 biggest US companies. So instead of investing in each of the 500 biggest US companies, we can simply search for S&P 500 on our broker like Robinhood, trading 212, Trade Republic, for instance, and so on. I have a tab where I can explore ETFs, or I can type S&P 500, for example, and click on buy. And you can literally own the 500 biggest US companies in a blink of an eye. The interesting part is that it historically returned around 12% a year on average for the past 80 years. Sometimes lost 50% of its value, sometimes gains 50% of its value, but if you own this ETF, you can almost be sure to have continually safe returns. So if someone comes to tell you about a new investment that makes a nearly 8% or even 10%, don't take it. It's not worth the risk. Alright then, how to diversify? But always keep in mind that the money you invest is the money you are willing to lose. Again, forever. You could diversify across industries. The only reason is that the industries are not 100% correlated, so sometimes one goes up and the other goes down. Could be tech stocks, energy stocks, as well as healthcare and consumer staples. For instance, the energy and healthcare industries are not always correlated, which is good news. And during the pandemic, Johnson & Johnson went up while Chevron went down, losing 25% of its value. You can also diversify across market caps, so small cap companies, mid cap, as well as large cap and mega cap companies. Ranges from less than $300 million to more than $200 billion in market cap valuation. Large cap companies are typically older and well established, and they usually pay reliable dividends. Could be Chevron, TSMC, Apple, and Home Depot, for instance, which have strong competitive advantages. Feel free to invest in different countries, as this will allow you to put your eggs in different markets, so different opportunities, ups and downs, and in-betweens, and so on. I would recommend investing not only in the stock market too. It could be gold, cryptos, and real estate. And again, they are not 100% correlated, so this can prevent big losses when the stock market is down or up. Alright, how to value a stock? And I simply take companies that I know or like or simply heard of somewhere. Could be anything. I then build a watch list. You could take a pen and a piece of paper for that, but I prefer to use Google Finance. And then I make some research on Google about two things. I want the company to have a competitive advantages over its competitors, and I want the company to be well managed. Coca-Cola has a competitive advantage with its secret recipe, and it also built strong brand recognition for the past 130 years. And thirdly, I look at the company's financial statement. I know, it seems like a hard task to do, but no worries, you just have to read some lines on Google here and there. First of all, I look at the company's dividends. If it does not pay dividends, I simply ignore the company. A dividend payout is most of the time a sign of a healthy company, and it's also a security if stocks are down. And you have to check for how long the company has been paying dividends, if it can them or not, and what's the dividend yield, not too much or not too low, between 2 and 5% if possible. Then I look at the company's net income, so it represents the earnings once all expenses, interest and taxes have been subtracted from revenues. I also look at earnings per shares, so the net income divided by the number of shares outstanding. So if the company earned $1 million this year and has 500,000 shares, then $1 million divided by 500,000 equals 2. That means as an investor, you would have $2 for each share you buy, and the more, the better. Then the debt to equity also, P ratio, and return on capital. And please remember at least one thing. I always look at the numbers for at least the 5 last year, maybe 10. When it comes to dividends, I look at the whole history of the company. There we go. Questions I didn't know how to answer myself a few years ago, and that I'm glad to share with you. And if you have liked this video, then you will enjoy this one, where I talk about the beginner errors I used to make in the stock market, and this one, where I break down investing and my own strategy if I had to invest $100 right now. Thanks so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.